Common stock valuation. First, we'll talk about the definition of common stock. Common stock is what's generally known as ownership in a corporation. Most of the time when we talk about stock ownership, we're referring to common stock. Common stock are the shares which have voting rights attached to them. Generally, these are the shareholders that elect the board of directors, which then goes on and hires company management. Common shareholders do not get preferential treatment either in dividend distributions or in the event of a company going bankrupt and liquidation of assets. Generally, the common shareholders are usually the last ones paid in those situations, but they are the ones who get to vote, and they are the ones who effectively control the corporation. Dividends are not required to common stockholders. Many companies pay dividends to common shareholders, and some companies pay them very regularly, and some companies pay quite a bit, but there's no legal obligation to do so. That's generally something that's decided on by the board of directors of the corporation, and in many companies the dividend amount, if there is one, fluctuates. In other companies it's more predictable. Generally, when you receive dividends from a share of common stock that you own, that's treated as ordinary income, and so because of that, you'll be taxed, which causes a situation that we call double taxation problem, because the company has already paid corporate income tax on those profits, and now you're going to go pay regular or ordinary income tax on the same money. Biggest reason to own common stock for many investors is that they're hoping that the stock price itself is going to increase over time. We call this capital appreciation. In some cases, there have been very large amounts of money made through capital appreciation of common shares, and some individuals have also lost a great deal of money depending on how well they selected the common stocks that they own. If you own common stock shares in excess of 12 months, then the gains may be actually classified as something called long-term capital gains, which have a lower tax rate. And that's something that a lot of people have to consider when they buy and sell shares of common stock. And in many cases, again, lots of investors buy common stock not for the dividends so much as sometimes for the capital appreciation. There are some people that buy for both, and there are some cases where people buy common stock mostly because they want to collect the dividend. But this is a very significant reason for ownership, and in many cases provides very significant value over time. One of the questions that arises is, what determines the price of a share of common stock? How do you determine the value? I mean, what causes a stock price to be what it is? There are many models that attempt to explain prices of stocks. This one here is maybe the simplest with relation to common stock. This is called the constant growth model. And basically what this model says is that the price of a share of stock, if you look right here, is equal to the dividend divided by the required rate of return minus the growth rate. Dividend is fairly obvious. That's the dividend that's declared by the company. Required rate of return relates to what the investor's expectations are for this particular stock in terms of its performance. Investors might look at a stock and feel certain ways about how risky it is, about what the external environmental conditions are like, about the company's position competitively in the marketplace, and they may form a set of opinions that lead them to say, you know, this is about how much we would need to make in return through ownership in this stock in order to feel comfortable. Growth rate relates to the expected rate at which the company is going to be increasing its sales and its profits and market share and all of those things. Growth rates, or expected growth, if you look at how company stocks behave, have a lot to do with pricing. So when you look at this model, we've got an example here. a company that pays a $1 dividend. The investors expect about a 10% return, but it's also a company that's been growing at 8% a year. And when you plug all this in, what you wind up with is a $1 divided by 10% minus 8%, or in other words, 2%, gives you $50 per share. So this would be a stock with a $50 share price. Now the model seems very simplistic at first glance. However, it does capture a great deal. And the first thing we need to say about this is no one sits there in the stock market with a little calculator or computer and plugs in a bunch of numbers into this formula and then publishes a stock price. That's not what happens. What actually happens is the investors decide that they want to buy a share of stock for some reason, and so there's lots of demand. And if there's no one selling, then that means there's very little supply. And so price will change until we reach a state of equilibrium where there's enough people selling and enough people buying. And that's what really causes share prices to go up and down. This model attempts to explain the dynamics that cause that to happen. And if you look carefully, although it looks very, very simplistic, dividends really kind of capture a lot of the things about the company's current financial performance and how those relate to the company's stock price. Required rate of return captures a lot of stuff about the investor's current attitudes regarding risk and how the company is perceived in terms of its abilities to perform in the future. And then growth, obviously, captures the marketplace's views on what's expected from this company in terms of how much it's going to take away from its competitors in the near future, how it's going to fare versus all of the external forces that are out there. And so this model really is an attempt to explain what actually goes on in the day-to-day marketplace. We call this the constant growth model or the common stock model. And it's, again, to summarize, we would say that the price is equal to dividend divided by the required rate of return minus the growth rate. And you can go ahead and look at this example. You could attempt a couple more by coming up with your own numbers and plugging them in. The math is obviously very simple. And again, that's the common stock model.